We've all heard the news that the average 30-year mortgage in the United States has just surpassed 7.6%, the highest since December 1st, 2000. From this perspective, the situation has become dire. Everyone is now wondering how it's possible that this market remains stable. What started as an annoyance has now expanded into one of the worst asset bubbles in financial history. The story of how we got here explains the future and raises serious red flags regarding the future states of this unstable economy. The housing crash that's coming will be the worst we have ever experienced, and to show you why, we take one step back into history, looking at clear evidence that what is happening today is far from normal. You see, a lot of people, when they show you a chart like this, they're showing you housing prices throughout history. But this chart has a severe flaw. It fails to capture the all-important aspect of inflation over a 40 or 50-year period. Inflation's impact becomes clear when considering a house bought for $200,000 in 2000, which would be worth about $356,000 in 2023. So, while it may seem like a gain on paper, it's not a true increase in value. To assess a housing bubble accurately, we must adjust for inflation, revealing the real extent of home price increases. The inflation-adjusted Case-Shiller Index provides this accurate perspective, surpassing the 2008 housing bubble, considered a significant event in U.S. history. With data dating back to 1889 from the research of Robert J. Shiller and Carl E. Case, it's evident that the current housing bubble is even more severe than the 2008 one. This ban on normality began around 2012, and since then, we've drifted far from what we once considered normal. So, what makes me believe we might return to that normal state? Well, there's a historical point in this argument where even the most optimistic folks start losing their ability to argue against an impending crash. You see, the development of the 2008 housing bubble after the year 2000 wasn't all that surprising. The reason behind it was the historical high interest rates. When you apply those rates to today's standards, you'll notice that over the last 30 years, we've seen a gradual decline in rates. This decline provided the ingredients for the 2008 bubble to take shape and eventually burst. But here's the lesson. After the 2008 bubble, the Federal Reserve continued to keep rates at new record lows, pushing them down to 2.6% at one point. This move led to a new bubble that formed from late 2011 to the present day. The real price of a home, adjusted for inflation, surged by 66% beyond the 2008 increase. This is an unprecedented and rapid acceleration for our country. Every time we've witnessed such acceleration, a crash followed to bring this phenomenon back in line with the historical average. Now, if you're looking at this chart and thinking, that's not quite enough for me, there's another critical piece of evidence that, in my opinion, seals the deal and essentially proves that something has to give in the market. But before I show you this aspect, please take a moment to support the channel by hitting that like and subscribe button. Every like makes a significant difference for the channel, and I genuinely appreciate your support with just a quick click. Now, back to the point. While the housing market is heavily influenced by interest rates, we know that most buyers and investors typically purchase homes using some form of loan, often the 30-year fixed mortgage. Without diving too deep into this topic, it's important to understand that the 30-year fixed-rate mortgage is essentially derived from the 10-year Treasury. This financial instrument right here dictates what mortgage rates will be. So what does all of this have to do with your home and its value? To answer this question and finally drive the point home, we need a bit of context. Think of a 10-year Treasury note as a special kind of paper that the government uses to borrow money. The way the government borrows money is quite simple. They take your cash with a promise to give it back with a bit of interest after 10 years. Currently, the interest rate they're paying is 4.5%. Now, here's where it gets interesting. There's also a 2-year Treasury note, and if you look at that one, the interest rate they're paying is 5.02%. This means the government is offering a higher interest rate for borrowing your money for 2 years instead of 10. Typically, it's the other way around. Longer-term loans should have higher rates. When rates are inverted like this, you get something called an inverted yield curve. In simple terms, inverted yield curves are a clear sign of an impending recession. Every time the line on this chart dipped below zero, indicating an inversion, a recession followed. This held true in the early 80s, early 90s, early 2000s, 2008, 2020, and now, if you zoom in, you can see the issue. This chart is from 2022 and doesn't show the latest developments, but we've gone even deeper into the inversion and are now starting to come back up. You might be thinking, well, we're coming back up and that's good news. Maybe we've avoided the storm. However, this couldn't be further from the truth. The worst part, and when a recession typically kicks in, is after the inversion is complete and the line moves past zero into positive territory. Take 2008, for example. It was years after the inversion that the real pain began. Now, we're facing an extremely troubling situation. The Federal Reserve, Fed, is pushing rates to the limit, but the bond market is somewhat challenging their stance. This is my final point when it comes to a future crash. For instance, the 30-year yield is almost identical to the 10-year yield. This suggests that investors are starting to believe there will be significant inflation in the future. We can deduce this because any rational person would buy a 30-year treasury if the rate was appealing. But it's not, mainly due to the considerable uncertainty about the next few years. That's why people are choosing the 10-year, which provides a rate that seems outrageous when compared to the 30-year yield. If you find this part a bit complex, don't worry. It's a nuanced topic. In essence, investors are starting to believe that inflation will persist based on these treasury yield curves. If their belief holds true, it leads to a critical question. As the Federal Reserve raises interest rates to combat this inflation, what happens next? Well, there's a peculiar twist. To see inflation rise once again, you'd need the Fed to eventually change its course and yield to inflation. And for that to occur, you typically need a crisis. Now, the crisis is staring us right in the face, and it's related to the potential complete collapse of the housing market. Rates in the financial world are akin to gravity, and the territory we're entering into is largely uncharted. When something breaks within this intricate system, it could potentially bring down the colossal house of cards that's been under construction since 2012. The bubble we used to regard as the biggest in our recent memory may soon appear insignificant when compared to the colossal bubble we are potentially facing now. The dynamics at play in the market are complex and multifaceted, but they all interconnect to create an intricate financial puzzle that, if mishandled or if the pieces fall into the wrong places, could result in a devastating financial crisis that could affect us all. This is a situation that we should be keeping a close eye on, as the potential ramifications are far-reaching and could reshape the financial landscape in ways we may not yet fully comprehend. In conclusion, the housing market is facing unprecedented challenges, with the potential for a crisis that could dwarf what we experienced in 2008. The signs are there, from historic interest rate developments to the inverted yield curve, hinting at a looming recession. It's a complex financial landscape, and we need to pay close attention. The future remains uncertain, and the ramifications of these economic shifts could be far-reaching, reshaping our financial world in ways we may not fully grasp yet. Keep an eye on these developments, stay informed, and make wise decisions in these turbulent times. Thanks for watching. If you found this video valuable, please like, subscribe, and share your insights on the global housing crash in the comments below. Your input is appreciated.